Hey guys, this is Mr. Breen, and in this video I'll be talking about returns on investment. Okay, so one of the first factors that's going to play into returns on investment is risk. Okay, when risk is high, returns are relatively high. When risk is low, returns are relatively low. Now let's think about why this would be. This is not because an inherently risky investment is also inherently high returning. So I don't know what would be a risky investment. Maybe investing in a mining operation on the moon. Okay, now that might be really, really risky, but it might not offer a really high return just because who wants anything that you could mine on the moon? Now, the reason why higher risk leads to higher returns is this. Let's say you have company A and company B. Now, let's say that these two companies are going to launch some business venture, and they're trying to sell bonds in order to do so, okay, so that they can raise money to do this. Now, let's say that company A has a failure rate. Their risk of failure is 10%. And company B has a risk of failure of only 5%. And they each offer bonds that pay a 2% rate of return. Okay, well, you know what's going to happen here is that company B will sell plenty of bonds, and company A won't sell any. Okay, because why buy company A's bonds, which are riskier, when you could get company B bonds that have the same exact payout? So company A is going to have to offer better terms. Okay, the only way for company A to get anybody to buy their bonds might be to offer their bonds for, say, maybe 4%. I'm just making this number up. But this higher rate of return might entice some of the investors who would otherwise have purchased company B's bonds. Okay, they're willing to take on a little bit of extra risk, but only if they are promised a little bit higher returns if it works out. Okay, another factor when it comes to returns on investment is liquidity. And this kind of works in the opposite way. If an asset is highly liquid, in other words, liquidity is high, returns are relatively low. And if liquidity is low, then returns are relatively high. Now, this is for the same reason as it was for risk, right? It's not because illiquid assets are necessarily higher returning just by nature of their very illiquidity, right? So a lot of people think houses are good investments even though they aren't. Okay. A lot of people think houses are great investments. And they're very illiquid, right? And that's why they must have such high returns. Well, no, not exactly. In fact, houses don't have very high returns once you account for inflation. The reason is, again, the same. Let's say that company A offers some investment opportunity that is highly liquid. In other words, it's easy for people to get their money out. Okay, and company B offers some investment opportunity that is relatively illiquid. Okay. Once you sink your money into this investment, you aren't getting it out for some time, or it's going to be expensive or difficult to get it out. Okay, so if they each offer, again, a, let's say, 5% rate of return, again, you know what's going to happen. Nobody's going to invest in company B's investments because they're getting the same return for a product that's harder to get your money back from. Okay, in order to get anybody to purchase this company B asset, they're going to have to offer something more like 8% or 10%. Okay, you can really see this dynamic at work when it comes to savings accounts versus checking accounts. Okay, checking accounts pay no interest. Savings accounts pay some. Okay, because savings accounts have low liquidity, okay, they're going to pay out a little bit higher rate of return as opposed to checking accounts, which pay no rate of return and are very liquid. Okay, so let's see how this works. Okay, so for a certificate of deposit, it's very unrisky. So let's say the risk is a 1. Okay, and the liquidity is also pretty low. Let's say the liquidity here is, say, also a 1. So it's low risk, but it's low liquidity. So we'll say the return, or the return on investment, or rate of return, ROI, ROR, is, let's say, sort of medium. Okay. A checking account is very low risk, very high liquidity, so very low rate of return. For U.S. Treasury bonds, it's a very low rate of risk, maybe a little higher than a checking account or a certificate of deposit. But the liquidity is also a little lower, maybe let's say a 7. You can resell them on secondary markets, right? So it's a little bit higher. Okay. For Ford Motor Company bonds, we might say the risk is maybe a little higher, maybe more like a 4, and the liquidity is, it's a little harder to sell, so maybe a 6. So it's a little bit higher compared to U.S. Treasury bonds. And then Ford Motor Company stock is riskier still, maybe a 6 in terms of risk. These are just arbitrary numbers I'm giving them, just to rank them. And it's probably similar liquidity. So because it's higher risk, this is an even higher rate of return on investment. Higher still.